now. Let's welcome on board then William Lee, Chief Economist, Managing Director at Global Economic Advisors, talking about what he's making of the world right now. William, hi, morning. Great to have you on ET Now. William, just wanted to understand what you're making of Trump's latest rhetoric on Iran.
Well, I think the uncertainty about what exactly is going on in terms of the traffic is probably a source of a lot of the uncertainty. But the fact that oil pricing is still below 100 means that some oil is getting through. The question is how much. And I think the dispute is where the U.S. is now saying we're going to use economic sanctions rather than military. And I think that is causing more consternation about how effective those economic sanctions will be on Iran, which is already doing very badly, given the blockade has shut off their source of revenues. So I think the state of uncertainty is very high. But as you saw from what you just summarized, the markets have looked beyond the energy situation. They really are focusing in on profits growth, which has been phenomenal last quarter. And now this quarter still is in the 20-30% range. And I think that's the powering of the markets that continues to go on. And people feel that the AI trade is the one that is the focal point of where a lot of the investors are concentrating, trying to understand exactly how the AI trade is getting to be funded, especially with the presence of private credit being so much more dominant now, especially as Jensen Huang is trying to create a whole new asset class for economic computing power, for computational power into a whole class of financial assets using private credit, which I feel is somewhat risky and will likely involve risks for the banking system as a whole, because banks are always the ones that are supplying revolving credit lines and other facilities for these private capital firms to draw on if there's a liquidity shock. So all in all, I think the state of the markets actually is quite good in terms of the equity markets going forward. And while the energy situation still remains to be resolved, that has been range bound in terms of pricing. We're not going to get much above the high 90s, low 100s, and we're not going to get much below the low 80s or high 70s. So that range bound area in the energy markets, I think, gives a lot of comfort to the markets for allocating capital, and clearly a lot of the capital is being allocated to the AI trade.
William, very curious to know, therefore, you've seen a cool-off at least overnight in the bond yields, and that's because the US is now suggesting that they're going to double down on bond repurchases. One, how realistic is that, just given the fiscal deficit that they have, and it continues to get stretched? Where are they going to find the resources from to actually increase buybacks there? And therefore, this move on bond yields, opportunistic, if at all? Are you making the most of that opportunity?
Actually, that's a great question. I've spent most of my day talking to clients on exactly this topic. And when I think the question that you're asking is a very good one, because we haven't seen this kind of trade since the days of LTCM, where the off the run, on the run arbitrage is something that was a source of uncertainty in the markets before. Scott Bessent turned it around and is using it as a treasury device for trying to let the markets know a message, which is to say the Treasury Secretary is watching these long-term rates. He is selling more issuance of 20-year bonds and buying up the off-the-run older vintages of that same maturity of 20 years. So he's buying up older vintages that are heavily discounted right now, that are called off the run, and selling a lot of on the run securities, and that doesn't involve any net inflow of money at all. It's just a matter of arbitraging, sell high, buy low, and that is, I think, a way of trying to raise the price of the existing pool of off-the-run 20-year treasuries and 30-year treasuries and such. And they'll be doing this for quite a while. And they also announced a net issuance, an increased net issuance of the 20 years to fund the booming deficit right now. So I think it's a very interesting trick that a hedge fund manager, a former hedge fund manager, is now using as Treasury Secretary to let the markets know, hey, I am watching the long-term rates. I am not going to allow disorderly markets, especially with the less liquid off-the-run treasuries, to create volatility in the long-term interest rates. And that itself calmed the markets. And you saw the long-term rates start to come down, both on 20 and 30-year areas. So I think the trick is working for now. And the question is, how long will it continue to work? And that's yet to be seen. But certainly the Treasury is committed to doing this all through between now and say November.
William, though, anything from the FOMC minutes which really sort of stands out and gives any direction to how one should be investing globally?
You know, these minutes, I think, confirm what I had said on your program in the past, where I think that the sense in the last FOMC meeting, especially by the more junior members of the FOMC, the newcomers, the president of the Cleveland Fed and the president of the Dallas Fed, who themselves had very good credentials. The Cleveland Fed president comes in from Goldman Sachs as a Goldman Sachs trader. And the president of the Dallas Fed comes in from the New York Fed, where she spent her entire career on the trading desk. And coming in as traders, when you come into the FOMC culture and you become a policymaker rather than just a tactician, you have to establish your inflation fighting credentials, and you have to establish the fact that you can see beyond market tactics and you actually understand policy. And so I think these people have taken a very high profile stance in trying to establish their inflation fighting credibility, especially in the light of the fact that Chair Warsh is going to be revising or trying to revise the framework under which monetary policy is going to be conducted in the future, and what kind of inputs are used to inform those decisions. And I think these newcomers are being so vocal in their dissent, just to establish the fact that they are players in the game, even though they're newcomers. So I think I would I would look past a lot of this rhetoric as political positioning rather than something serious about wanting to raise rates.
Understood. Okay, William, great to have you today on the show. Thank you so much for your time.
Thanks for having me.